Jack, good to have you back on the show. You describe a K-shaped recovery. Tell my viewers what that means.
Sure. So certainly there's been a divergence between what we're seeing in the stock market and the underlying economy, creating what we'll call a wedge. But even underneath the surface, we're seeing those who are insulated from the pandemic and the lockdown, and those who are really suffering from it economically. So, for example, those workers who can work from home, generally these are college graduates. Those who have to go into work, and many of those workplaces are closed, those are generally high school employees. So remarkably, while we've seen certainly a massive job decline since the beginning of these lockdowns, there is a roughly a 1 million job decline in college-educated workers and a 4.5 million job decline in high school educated workers. So there, also within the stock market, I mean, just as look at air freight versus passenger air travel. Air freight up roughly 40 to 50% from the pre-crisis peak, and passenger air travel airlines down 40 to 50%. So a lot of divergences going on underneath the surface. And of course, even just New York real estate, New York multifamily apartments down about 10 to 15%, and single family homes in the New York and New Jersey area up about 2.5%. So clearly there's this wedge, not a surprise, going on underneath the surface.
Jack, I like the description, and it rings true with something we were talking about with stocks specifically here, which is the amount of dispersion between different parts of the market, where you've had the companies that can actually thrive during this work from home period, all the cloud stuff going way up. Then you've got some of the more consumer plays where if you've got the right brand or e-commerce business model, you can do well. And you kind of just go down the spectrum until you get to the very bottom, which is like Cody, a brick and mortar mall retailer that's just still at the lows. So does that give some credence to the notion that this market is not totally disconnected from the economy? You hear a lot of people kind of default to this hot phrase where the market is disconnected from the economy. I mean, it seems like the market is really deciding who's surviving and who's not.
That's true, Oliver. There are certainly winners and losers within the stock market, but if you look at the S&P overall, and that most of the, or at least a majority of the move driven by the top 5 largest companies, all of which are tech, it's interesting to note that while they're collectively about $7.5 trillion in market cap, or about 30% of GDP, they only employ about 0.9% of the workforce. So, not many people are able to ride that magic carpet much higher, at least in terms of Main Street. Certainly Wall Street on a tear, Main Street, suffering behind. And you can see just this divergence where, we'll call this, we're calling it a radical or a square root type recovery, whereas stock market looks more like a V.
Yeah. So the overall stock market gets that V as there's a big drag from the big companies that are pulling it higher. Jack, do you have a strong view on what we should expect if there are any changes? You've got a chart looking at the S&P 500 valuation versus a few things, versus the actual inflation potential. And I think that one is interesting here, because if there is inflation pickup, is it obvious what that means to the market? I mean, I imagine it probably wouldn't be good for some of the valuations in high growth tech, but there's like a whole other corner of this market that's not small that it seems might like that. Higher rates, better for banks, some of the cyclical stuff that's been stuck?
Sure. Certainly would cause a rotation out of this, what we'll call long duration growth stocks and into more of the, nuts and bolts cyclicals and value oriented stocks. Absolutely. So if you look at the, the PE as a function of the inflation rate, you can see that with low inflation, low interest rates, we can sustain these elevated PEs. one of the things that would cause pause for us is anything that would prompt the Fed or prompt the bond market to ratchet rates higher. Now, that said, we do have a high frequency gauge of the 10-year Treasury that we look at the relative relationship between copper and gold. It's been a pretty good indicator. It's saying right now that the 10-year Treasury should be about 1.2%, not 0.6. So certainly, we could stand to see rates rise a little higher, and that will cause at least a near-term headwind for equities.
Jack, the chart we're looking at, inflation versus PE, generally as the inflation climbs, the valuation of the market goes lower. But with the Fed not doing anything, really, it seems like at all, it seems like they're going to let inflation run warm, make up for lost ground. We have no idea really how much. So if there aren't hikes, does the role of inflation differ at all in its effect on the market, or is the just actual underlying reality of inflation enough to keep that relationship intact, or do you need the hikes to go along with the inflation to then get in the way of the market?
I think you're right. It's the hikes. It's not the inflation rate itself. I think that it would be a perception that the Fed will have to hike to tamp down inflation. But Powell last week is on record saying we're going to let it run. Now, we're not going to be worried about 2.5% inflation. It's not going to necessarily prompt us to switch gears here. So I think for the most part, I think the market had it right. It responded very well to Powell's remarks. Interestingly, gold, I think, had it wrong. I think that's also a very favorable environment for gold. If we see inflation go up and rates not follow, I was actually surprised to see gold fall in response.
Jack, overall, the valuations obviously are still high. If the Fed is not hiking, it's so good for markets generally, good for things like gold, as you described. But if we've been in this environment where they can always cut and cut and cut, and our hikes get reversed after we throw a tantrum, I mean, if they're not going negative, then what's the catalyst though for valuations to expand? Is it just froth, sentiment, recovery? Can we get valuations to expand even if the Fed is on hold?
I'm not sure, we're banking on valuations expanding. I think what we're looking for now is just organic earnings growth. I mean, at some point we do need something substantive to sink our teeth into, and it just can't be central bank policy. So I think at some point the Fed has to go ahead and keep rates as low as they can, keep real rates negative, and let earnings work. So I'm hopeful we will start to see earnings growth turn around. We will. And it will follow the market higher from there.
Okay, and we can see on your chart here that we are pretty far to the right on the x-axis of the CAPE ratio. It's definitely a pricey market, but Jack, there's signs of improvement. The last chart I want to make sure we hit that you have in your report is looking at some of the higher frequency data. The restaurant bookings seem to be pretty consistent here, and also it seems like we're doing a little flip-flop. The last week has been more about COVID cases in Europe than it has been here. So maybe the domestic story, is it improving right now?
Yeah, I mean, we did make an incremental shift into international equities maybe about 2 months ago, expecting the dollar to decline. So that's been favorable. It's been a tailwind for our overseas investing, but you're right, we are starting to see some increases here at home in economic activity and a few setbacks in Europe. So we'll continue to monitor, but overall, general trends are 2 steps forward, 1 step back, but in general we're moving forward.